and this actually is a segue to our next kind of discussion topic, which is that the housing market risks slowing the U.S. economy at large. But the reason that may sound like wow, that was a weird quick pivot. They're actually interconnected to what you were already talking about earlier. If buyers have leverage and sellers are running risk in the segment of the economy that is the second largest only to our medical sector, then you are tinkering with major components of the economy at large, by which you need to look at your real estate professional and your mortgage professional more as an advisor than you do an order taker.
Absolutely.
Yeah. So that's why it might have sounded like a quick pivot on the top, but this is why Uncle Andy in the corner is like, no, these things are connected, and this goes to our next topic. So, look, the real estate and mortgage market as a sector is the second largest sector only to the medical field. That's massive. It is a multi-trillion-dollar sector of the economy, and it's not just the mortgage and the real estate, it's all the other ancillary components of that as well. And it requires a depth of, I'll say, behavioral understanding, the psychoanalysis and understanding buyer psychology and human behavior as part of this, because they're buying their most expensive asset, because it's their biggest monthly payment. They're transitioning from being a renter to an owner. There's all these other factors. It's not just what you see on paper.
Absolutely.
So I want to talk about that today, guys. Like, I know that we're seeing buyer behavior change too. You know, people can make all these warnings about this and whatever, but like, what are you guys actually seeing out of buyers these days?
What I'm experiencing the most is that, you know, at least for the younger generation, like the Gen Zs and what we spoke about in the past, is that they want to buy sooner than a lot of like millennials and people like that I've worked with that are older, and they're starting sooner. And it's not like to the point where they're like, hey, I want, you know, my forever house. They just want something that's better than where they're at right now. And I think that builds a lot of momentum for, you know, young military service members, you know, young entrepreneurs that are doing fairly well for themselves. I think there's a pocket and a good opportunity for young buyers to get into the market, because they don't really have that mindset of past habits, like, you know, like they've gone through a meltdown, or everything for them is fairly new. So they're more aggressive with the type of behaviors that they're going to have towards buying, investing. And I feel that if they have the right guidance and they have the right information in front of them, they're almost just needing someone to point them to how to get to where they need to be. And that's one of the behaviors I'm seeing in you know, Gen Z buyers, millennial young buyers, and stuff like that on my end.
Now, Memo, you know, you're going into your 20th year, or we're in your 20th year originating mortgages. What kind of buyer behavioral changes have you observed or experienced this year, maybe even to 2024, that are just like so different than when we first started this whole thing?
You know, buyers are coming in with less confidence is what I've been noticing. They're just not as confident as they were before. Before it was just like, oh yeah, okay, it's a $25,000, it's a $3,000 payment. Okay, I'm gonna figure it out, right? But we gotta remember and remind ourselves that our income has not increased with the way home appreciation has been, with the mortgage payments that we're seeing, with the rental payments that we're seeing, you know? And so I'm seeing more of our clients nowadays being more hesitant. Like, can I do a $5,000, a $4,000, $5,000, $7,000 mortgage payment?
Those are some steep payments, man. I mean, I get
you're
that.
talking about $990 VA. We just wrap one up, and it's a $7,000 payment.
That's insane. Yeah, well, in that case, that BAH is covering that, right? Or no?
You're saying it's in this
not.
case, luckily, both of the couple, they're both veterans. They received both of them 100% VA disability.
Oh, sorry. I was saying an active. I was
Exactly.
just saying active duty. Sorry about that.
So they're not, and they both hold, jobs, civilian jobs right now. So it works out for them, but it doesn't. That doesn't happen to everyone.
That's just not true for everyone.
And their
choking down a $7,000 month payment.
And understanding, and the understanding that they already have by owning a home, because they also own a home. It was hesitation.
Wow, man.
It was hesitation. Can I do that? Will I be able to do that? How do I adjust to everything else that's going around? And so that's what I'm seeing more of, and the difference is hesitation.
Now, I understand that if we magnify this and multiply this by 100, by 1,000, by 100,000, yes, I can see that putting a little screeching halt to this sector of the economy, which then spills over into the economy at large, as is being hypothesized. Yeah. Do you agree with that right now, or do you need more time to kind of assess what kind of impact, if any, this is going to have on the economy at large?
It's having, I think it's already having an impact.
So you've already come to the conclusion.
Oh, yeah. For sure. It's already has an impact on it. We see it.
Yeah.
Real estate brings other things to life. It brings more construction. It just brings people to want to buy. And I know in our next topic, we're going into it, which is why we're starting to see more investors going into it. We're starting to see with social media, the way things are changing. Before social media, who wanted to be an investor? Once in a while, we would see a fix and flip show. Now it's almost becoming where homeowners won't even have that dream of being able to do that, because you want to have your first home. You want to own your first home. And a lot of them don't and probably won't be able to.
So you're already at the conclusion that we're already seeing the negative impacts of this hesitation, of the pricing, of the rates, of the monthly payments. But yet, at the same time, at the beginning of this show, I was asking about price changes and appraisals, and you're like, I got 8 appraisals this week. Well, 8 appraisals is more than 4 and more than 2. Well, so clearly people are overcoming this, either with your advice, your counsel, or on their own, to come to the conclusion that this is still the right choice.
I mean, there is, but you have to be very prepared. You have to have, what I'm seeing is most people coming into the market, there's going to be a couple that's coming in 2 incomes, and they're pretty stable. So that's the difference. Whereas before, you would see people that are coming in and it would just be 1 income. And so they're able to go and afford these properties. Right now, that's not what it takes. Right now, it takes 2 incomes to make these things happen.
All right.
And it takes actually a lot of clients are having 2 jobs.
Yeah.
This
is going to be an interesting one to watch, because I think once you get into quarter 4 of 2025 and we eventually get into 2026 and we get all that quarter 4 data that kind of wraps up and concludes, I think in the new year, we're going to look back and mark this moment and go, okay, we're already in the middle of some sort of slowdown. I don't know that, again, I don't see it on the front lines as much as you do. I'm looking more of the data that's collected, which is mostly rearview mirror, and saying, I see that what you're saying is going to potentially wreak more havoc than it already has.
Yes.
I just don't know how much havoc it's going to. That, I think, is the uncertain part, because go back to inventory. With more inventory in an environment where there's very loud voices calling for rate cuts, if there are Fed rate cuts, then the mortgage market also has rate cuts because they're interconnected, not directly connected. Then I think some of that inventory can be matched with the demand. It can balance itself out, and maybe it's not as big as a threat in quarter 3 and quarter 4 as it feels like it is right now.
Yeah.
So it's a hypothesis. I understand this, but that's from Andy's seat. This is where I think maybe not. I know it feels like it is right now. Ultimately, I'm not sure how much of a dent it might be.
Yeah, for me, affordability is still the elephant.
Yeah.
It's what it is.
It's crazy. Just like when we were busy in 2021, 22, 2020, so was everybody else. So was the economy. So was every self-employed worker. So was every business. Everybody was booming. So when you said, real estate plays a big part, it does. Because as soon as we slow down, everybody else slowed down. Barbershops, just the minimal small businesses you'd see have influx of business, everything slowed down. So I feel that as the economy starts to pick up, or real estate starts to pick up, the economy's coming along with it, because that we have more opportunities to be able to have more money to invest.
Yeah, I think over the course of time, mathematically and numerically, I look at the force functions of formulas, and I go, well, there's all these little levers you can change. If your take-home money isn't enough to make the payment, what changes your take-home money? Well, making more of it, spending less, or your tax bracket. And then you look at tax policy, and then you look at all these other things that get floated around and talked about. And it's maybe some of that will help prevent some of these negative side effects from slipping off the cliff there. But again, that takes a lot of different variables all working in concert at the same time to prevent an ultimate dent in the overall economy, especially for a sector as big as real estate.
Yeah, just drop the rates already.
Bottom line, drop the rates, Brian.
And it is true. That is something, I'm glad that you bring that up, but builders are facing the same issues. They're not building as fast because of the uncertainty also. We don't want to overbuild and then just have these homes sit. Remember, contractors, new builders, they're not emotionally pricing homes. They're actually pricing homes to sell. They're giving incentives to these homes to sell. So for them, the homes are a commodity and they're just trying to sell. But because of the way the rates are and the affordability being the elephant in the room, they're just uncertain, like, are we going to overbuild? And maybe we just got to be cautious, and maybe we just going to release certain phases very strategically, you know?
So you've talked about this before with that cartel-like behavior and cornering the market.
Yeah.
I think builder attitude says a lot about their sentiment about the health of the market, because if they were concerned that housing prices dropping were on the horizon, they'd be trying to sell as much as they can right now at the price that they're at and trying to move those units, if you will. But them slow walking units on to maintain price, knowing that what their localized market demand is, to me communicates that they are either they know something we don't, or they're confident in something directly that we could also attach our confidence to and go, oh, they're okay with this pace of sale. They're okay with keeping price here. They're okay with giving these incentives. They're okay with paying for buy downs. Okay, so maybe that's at a better pulse of the overall market, even though I know we have pending sales versus new home sales. But I think the attitude about that the new home builders have says a lot about where they think price is going.
Yeah, absolutely. Absolutely.